I make it. And boom, right. So we are officially starting. Now, for the past, I think, week and a half, my main focus has been on breakout strategy. Okay. Now, breakout strategy is a beautiful thing if you know how to use it effectively. Right. If you know how to trade breakouts effectively, there is literally nothing that you can't do effectively, or there's no way you can't make any money, right? Trading. If you know how to effectively trade a breakout, because a breakout will give you one of two things, right? It'll give you a proper breakout, a reasonable risk-reward ratio, okay, and a proper breakout will also give you the benefit of trading in line with the chain. Okay, so those are the two things that you want to have in your advantage, especially as a new or developing trader. Okay. All right. Now, you can't start off as a trader, right? Or as anything basically in life. You start off at the top. You got to start at the bottom, right? And likewise in trading, the one thing that you're going to have to do is sort of like earn your way towards the top. And that is done so by continuously learning, right? Making sure you improve on your skill and putting the time and effort in order for you to get to sort of like that stage that you need to be, right? So it's not child's play. It requires a lot of commitment, but I am happy to see that there's a lot of you guys who are committed to the process, and you will sort of like reap the fruits or reap the benefits of whatever effort that you are putting in right now. Right? Just wanted to let you guys know. Now, breakout strategy. Okay, very, very simple, right? It's a very simplistic way of trading, and I love it because there's so many different examples that I can show you, right? Even today, there's an example. Yesterday, there was one. The day before that, there was an example of a nice breakout, because essentially what a market will usually do, okay, what markets usually do is they trade in ranges and then they break out of a range into a trend. Okay, those are the two main forms of or states of a market. Okay, the market will trade in a range, right? Which means it's going to move sideways or it's going to move up and down, right? So it's in range or out of range. So what's essentially going to happen with that sort of from that way of thinking that we have now, right? Like, okay, yeah, we get that the market is going to move up or down or sideways, right? Now, how do we make use of it? Now, the most difficult thing to do to trading a breakout is to try and trade a market that is ranging sideways. Okay, one thing we are going to touch on today is how to identify a ranging market and how to identify a trending market. Okay, this might seem like some very basic beginner type of stuff, but trust me, a lot of people can't tell the difference between a sideways ranging market and a trending market. Because a ranging market will keep you, it'll tie up your capital firstly, and secondly, you're going to be more prone to false breakouts, which means you're going to be trading a lot, right? Taking positions, and the more trades that you actually have on average, the more you expose your capital, the more likely it is you're going to lose. Because trading is like you're playing against the casino. Okay, you're playing against the house basically. And what you want to do is you want to limit the amount of trades that you take with to the high probability trade setups themselves. Okay, so the one thing that we're going to firstly do is to isolate what a ranging market looks like, and then what a trending market looks like, right? So when you're looking for, excuse me guys, I think I got something. When we're looking for markets to trade, especially in a breakout scenario, we're looking for markets that are trending. So if we can successfully identify markets that are ranging and that are trading, we know when to stay out of a market and we know when the market is ready to get traded. Because you don't want to have, even if you're not getting stopped out, you don't want to place a trade today and 2 weeks from now you're still in that trade and it's up 10 pips. You want a market that is moving, because breakout trading requires momentum in order for you to make money. Okay. So let me grab my tool. We're just going to use this 4 hour on the USD JPY. Okay. Now, I think I've said this before. The market is like, it behaves like a human in some ways. Okay. It's like when you have a big meal, right? When you have a big meal, you get sluggish, you get slow, you want to rest, you want to lie down. Right. So you might sleep for a while, and when you're done sleeping, you wake up basically, and you feel hungry again. Right. You feel like you can eat a cow, or at least half a cow, and that is essentially how the markets basically work in it. Okay. Now you have these drops, okay, these aggressive moves to the downside, right, or to the upside, whichever direction that you might see, up or down. And from that particular point, the market will go into a sort of like a ranging or sideways movement. Okay. Now, I will explain this much later on, the reasoning for that. Okay. But I don't want to confuse too many people at this point in time. Right. I want to keep it as simple as humanly possible. So let's just put the concept in our minds that the market drops very aggressively and then moves sideways. So like a person jumping out a 5-story building. Okay. You jump out the 5-story building, right? Even if you land on your feet, you're gonna lay there. You're gonna lay down for a second or two. Right? It might be an hour, it might be 2 hours, and then you might have the energy to get up again. So that's how the market usually behaves. So these sideways movements, okay, aren't that optimum for us to be trading a breakout methodology. Because as you'll see, trading a breakout methodology during these ranges or sideways market means that we're going to have a lot of trading activity, but very little or limited movement, right? So when you're sitting down after a huge meal, okay, when you're sitting down after a huge meal, okay, you've had a bucket of KFC, some chicken licking, and 2 large pizzas, okay, you'll be able to move, but not as actively as when you wake up and just have an apple. Okay, so that's the whole thing. Now, we see the market usually drop aggressively and move away aggressively from a swing low or a swing high. So in this example, we had a swing low, boom, which was established, and the market moved away from that swing low. Now, we can even bracket this entire area. I'll show you guys how to do that in a moment. And from the swing low, the market moved away and returned to that swing low the next week. Okay. So the following week, the market moved sideways. You can see that the range is actually pretty tight. And the market dropped down, boom, and then moved up. Now, this is essentially the characteristics of what a false breakout would look like. Okay, now false breakout would be something where you find a support structure, boom, okay, and the market sort of like saying, okay, yeah, now I'm going down, let's get in, let's go short. Everyone is like, no, I'm not convinced. Then you see the red candle getting bigger and bigger, so like it has its pulse and it just gets bigger and bigger, and by the time you enter into the market, your entry is somewhere around here, boom, on the short side. I'm not saying you specifically, but I'm just saying traders in general. But I do believe anyone who's traded on a live account especially has gone through the experience. You watch the market, right? You feel like, okay, it's breaking the support structure, and then as soon as you get into the market, it goes the opposite direction. Boom, gone. Now if you look from here on, market just push to the upside. Now, mind you, this is a 4-hour time frame, and that means each of these periods here is 1 week. So for 1, 2, 3, about 3.5 weeks, the market has been going in one direction against you. If you were tempted into getting that position short. Now, the swing high over here, right? The swing high there and the swing low here are sort of like standout areas. Now, with time and with practice, it becomes easier to identify these swing highs and these swing low areas, and it becomes easier for you to be able to trade outside the ranges and identify these ranges, because you can make some money trading ranges, but you have to use methodology which works for ranges. Okay, you can't take a breakout strategy and look to trade. Okay, the market goes up here, boom, and then I buy right there. Or the market breaks below this low, and then I start shorting the market there. Because, like I said, false breakout is something that is very, very prevalent in today's markets. Back in the day, when I'm saying back in the day, I'm not meaning 2000s, but probably in the 70s or something, breakout trading was a really good way to earn some money. But with the introduction of all these algorithms and all these competing commercial interests and stuff like that, it's become sort of like almost very, very difficult to identify which trades are false breakouts and which markets or which positions, opportunities are actual breakout trades. So with this range that you've identified, you've sort of like committed that you're not going to be trading one inside this particular range, any breakout strategy. And number two, you want to trade outside this range, and you can use the actual range as a support structure. Meaning, if the market breaks above this range, boom, right, and returns to this area, 107.08, then you are more willing to buy around that area. Now, if you look closely here, we had a return to that 107.08 level, boom, and the market pushed higher, right? So we can use the range as support structure or as a resistance structure. Sorry guys, I'm not sure where my mind is today, but I'm getting all sorts of words wrong. So you're breaking out this level and you spot that as sort of like your previous resistance area, which is now support. So likewise, when you're looking at a range, you're looking at not trading within that range, any sort of breakout strategy, and you're using that once the market breaks out and closes above that area for a return to that area, and then looking for a buy opportunity. So let's just use this as an example. Okay, so the market broke above this high. Now, when a breakout is confirmed, a lot of different people use very different sort of like ways to look at it. So for some people, a breakout is a 4-hour candle closing above a previous support or resistance level. For them, that's a breakout, which is fine. For some, it's 2 candles. Now, for me, essentially, what I'd like to see is a market break above, move away from that particular level, and then come back and retest that area. So it doesn't, depending on whichever time frame that I'm using at the time, it could be a day or two, right? It could be a week, it could be a month, it could be a few months. What if I have a previous structure, right? In this case, this support structure, this resistance structure rather, which became support. You see there's a bounce there, there's another bounce here, and the market broke above, boom, and came back into that area. Then we have an opportunity to buy. Okay, now if I see that, if I see those previous levels actually holding up, then I know I have a pretty decent area that I can look to buy at. Okay. Now, the moving away part for me is very important. It simply means that there was a lot of buying or there was a lot of selling around that area. Okay. Because what you need to realize is that the markets don't move because someone presses a button and it goes up, and then they press down button and it goes down. There's actual buying and there's actual selling. There's people behind the market. Well, there are companies behind the buying and selling. So all of these different influences end up as these candles that we actually see on the chart. So all of these different trading ideas, different trading philosophies, all these people with these conflicting beliefs, and some have the same sort of like beliefs of what the market is going to do. So all of that, the representation of all of that is what we see in one candlestick. So there's a lot going on within every single candlestick that we see. So what a return to this actual price for me represents an area where there was previous buying. Right? So people were looking to buy, right? Traders were looking to buy around that area, and they actually did push the price up. So this pushed the price up to break that support, that resistance. Right? Let's just call it resistance for now. So it broke this resistance, which means there was a lot of aggressive buying. So in my mind, I'm like, okay, since we had a lot of buying around that area previously, should the market come back to that area again, there's probably going to be some buying again. Okay, because if you're looking at how I would trade, right? So let's say I'm a big bank trader. The smartest thing that I'd be looking to do is analyze the market, right? So I analyze whatever market that I want to trade, and then once I'm done with the analysis part, right, I need to realize that entry is as important as the direction of the trade, right? Especially if you're trading large numbers, because if you buy the USD ZAR, right, so the South African rand versus the United States dollar, if you buy it at 13 Rand, but it first drops down to 12 Rand and then goes to 18 Rand, you'll still be profitable. Okay? But for one, you wasted all that time because the market kept you in drawdown. And two, because you missed out on that earning potential there. And two, what you did is you bought at a much higher price. Okay, which means you missed out on a lot of profits buying from 13 to 18 as opposed to buying from 12 to 18. So what happens is these players, although they still do believe that the market is going up, they believe like, okay, we're going up, the market is heading up. However, we're not willing to just buy anywhere. We're not willing to buy here anymore. What we want to do is we want to get a cheaper price for us to get back into the USDJPY. Right. So until that happens, we are not buying the USDJPY. We're going to be selling the USDJPY or taking profits, because that's all that really is. So you buy, the market goes up. And when people start selling, or traders start selling that particular asset, the market will drop. Okay, so when they start offloading, I think is a better word, when they start offloading those buys that they were building up, then they push the market inadvertently sometimes to the downside. Now, there's a couple of other things that need to be in check or need to be in line before we can confidently say, right, this is a trade set. Okay, I know we all like to have something when a lot of guys are like they're sitting on the MT4 platform, they've done the analysis, and every single thing that they have been analyzing isn't really going anywhere. Okay. Yeah, you can ask the question now. You can just raise your hand and then I'll unmute your mic. Okay, so there's a couple of other things that we need to be had in check. We need to have in line in order for us to have a trade setup. Okay. But this is crucially one of them. When you're looking at a breakout scenario, this is crucially one of them, because that means you're more likely, the probabilities are much higher that you are trading in line with where the big players are coming in, right? You want to be in line with where the smart money comes in. When they're buying, you want to be a buyer, right? When they're selling, right, you want to be a seller. Now, there's a lot of different ways to look at this, and if you understand how large corporations work and how they buy and how they sell, you'll understand that a lot of times they're not like outright buying one position, right? So they're not outright long on the USDJPY, which is they're buying just USDJPY. At some level, they're going to be selling it, right? But we know we don't really care about that. What we want to see is okay. Now, when it comes to the question is more about time frames. Okay, right now we're looking at the 4-hour time frame. So the question is, since you're analyzing the market on the 4-hour chart and I see a buy on the support, will it be the same when I switch to 15-minute chart? Example, on your chart, a false breakout, I see a buy on the 4-hour is the same on the 15-minute time frame. Now, the market behaves the same way across all time frames. Okay. Now, there are micro players, which means that guys who focus on trading small term, because the psychology around trading is the same throughout every time frame. So the patterns are going to be more or less the same. Now, the more reliable trade setups, okay, and breakouts will occur on the higher time frames. Right. So the higher time frames, because that's where a lot of the commercial or the big players focus their time and energy on, right? A lot of the smaller time frames are just algorithmic trading, right? It's just trading robots, algorithms, just continually beating each other up, competing against each other. And therefore that creates a lot of what may look like chaos on the 1 minute, 5 minute time frames, but you do have to take a step back in order for you to see the big picture. So if you feel like you need to trade the 15-minute time frame, but you have to at least start off from the higher time frames. Because sometimes you might look at the 4-hour time frame, and then 4 hours and be like, okay, there's an entry for you, and then you drop down through to the 15-minute time frame, and the 15-minute trend is the actual opposite of the 4-hour or the daily trend, and then you stuck because now you know. So from what I've learned, try to keep your time frames as minimal as possible. Okay? Limit them to very few time frames, and because really the whole issue or the whole thing of people trying to use a lot of different time frames is just a way to avoid losing. Like, people try and use analyzing the markets over analysis as a way to avoid losing trades, because they feel like if they spend more time looking at all these different time frames, it's going to give them a better chance of making money with that particular trade, which is really not true, because the market can either go up or down. And what you want is just a fair, decent probability that your trade will work out, and good risk reward ratio and decent money management, and you'll be able to make money long term. Okay. So yeah, you can use the 15-minute time frame, but as long as it lines up with the higher time frames, because that takes preference over the smaller time frames in any case. All right. Okay, let me just unmute you just to make sure that I answered your question. Okay, so you're good now. I'm not sure if I can hear you though. Yeah, so you said you're good. Oh, okay, okay. All right. Yeah, next time you can just speak because I did unmute your mic and you can just speak and then we'll be able to communicate better. But, so, as I was saying before, then, this is not the only tool that you're going to be using, right? Because once you learn to identify what a ranging market is, it's very easy and simple to identify what a trending market actually is, right? So trending markets are usually characterized, okay, by swing lows, right? So let's say uptrend, let's just use uptrend as an example, by swing lows being higher, right? And the swing highs being broken. Okay, so you have, this is what we call a swing low, right? As the market goes up and then it comes down. As the old trading adage goes, the market takes 2 steps forward and 1 step backwards. Okay, so 2 steps forward, 1 step backward. That's how a trading market usually works. And so, when we sort of like trading, we have to always keep that in mind. We can't expect the market to take 10 steps forward and then 1 step sideways and then another 10 steps forward. Because that's what we want when we win a trade, right? So when we buy, let's say here, okay, when we buy here, we expect the market to run straight forward, take profit, right? We make money and then we're out. But that doesn't happen. Market will move. That's the 2 steps the market moved, and there was the 1 step backward. So should it continue, it's going to give us 2 steps forward, right? And then another 1 step backward. And it's going to continue with that particular trend until it reaches the point where the market is probably going to change direction. Okay. All right, you guys are good. Okay, so let me try and use a higher time frame, like daily, to help us get in, so I can check with the concept of swing highs and swing lows, as well as identifying trading and ranging markets. Now, on the higher time frame, if we're looking at the daily right here, okay, so looking at this daily time frame, you can see that there was an aggressive drop to the downside. The market ranged a bit and then dropped again, and then ranged a bit and then broke out to the upside. Okay, that's pretty apparent. It's pretty simple to see. And which is why initially what you want to do is to have very simple, straightforward charts, something that along these lines, not too many different indicators and stuff like that, because it sort of trains your mind to see things without the assistance of all these other oscillators like overbought signals, oversold signals, and all of that confusing stuff, right? So you don't want to take sort of like the path of least resistance, right? The easiest route. You want to take the tougher route because it's going to train your mind to be able to see this, even if you do then end up using some of these oscillators. So these swing highs we can see here, we have a swing high here around April 2019, I believe, and then May, and then we have this one here in June, and do believe that this is July, and the market dropped to the downside. Now you can, it's clearly visible that these swing lows are being broken. Boom, market broke this low with this big candle to the downside. Now, like I usually say, this doesn't quantify a breakout in my book, right? In my book, let me just put it like that. What I'd like to see is a return to this area, which 2 months later, boom, we had. So we had to wait 2 months for this setup to line up if we're using the daily time frame. But in the end, it was worth it because we had a really good entry, okay, somewhere around there. And the market probably dropped 300 pips, if I'm not mistaken. So it dropped about 300 pips. And most of that 300 pips was in like 3 days, 4 days. So learning to identify these sort of like ranging markets. I don't want to use these big terms that a lot of these advanced guys are familiar with, like accumulation and release and profit taking. It's just sideways movement, and the market is moving up or it's moving down. Okay. So in this example, we can see that the market is predominantly down, okay, with this sideways consolidation, with this sideways movement, of which we don't want to be using a breakout strategy in. We much rather use a different strategy in order to trade these sideways ranges. And then once the market starts trending again, we can employ the breakout strategy. Now, this will be difficult for a lot of guys to do, right? Especially in the beginning, to adjust to the market. Right? Adjusting to the markets is like a boxer. If you're a boxer and you're fighting someone who is very aggressive, right? All they do is they come at you, they're not swinging properly, they push you and all of that stuff. And you're used to fighting people who are sort of like professionals. You see how the professional guys, they pick their shots. And now you have to fight with this type of person, right? You have that to then adjust your style of fighting to deal with that particular person at that time, right? Because that's all this really is, right? You adjust and you make your adjustments, you plan for those sort of scenarios, and then once the scenario pops up, then you'll be able to easily adjust to it. Because at the end of the day, if you're looking at markets, the market can either go up or it can either go down. Now, if you have a trading edge that you employ in your trading, which gives you an advantage of knowing a bit more than the next person, because at the end of the day, we're all trading with someone, right? You need to know something, or you need to be sharper at something than the next person or the other person that's on the other side of the trade. Okay. So as much as we might think that trading is not a competition, it is a competition, right? If you feel like I'm trading for myself, you're trading with everyone in the world, and that it's not like you need to be willing to die for every single pip. I know it's awkward to say that, to hear me say that, but I mean, I've gotten used to it. You have to be willing to work for every single pip, and by sharpening your skills and ensuring that you have the right type of mentality, it becomes easier and easier. So, what I'll be doing is I'll be posting a few more of these examples. Right? I did post a couple of examples for the guys on the lower time frames. You'll be able to see that. And during the session that we have on Monday, where we actually analyze the markets, okay, I do take the guys through how to look at these markets, which markets to look at. And for this week, I mean, I think 80-90% of the markets that we actually looked at are working out really well. Okay. Got a few positions that are still on myself, right? Aside from the ones that we made some money on yesterday and the day before yesterday. So, in a nutshell, if then you come through on those sessions on Monday, right? We do the analysis, right? You sort of like get the perspective of how it is to look at the markets, because now the markets are sort of like they're still, right? Even though the markets are moving, but when we actually make that sort of, we take that sort of thinking about, okay, this is what I'd like to see the USDJ before I do. We push up to the downside and then bounce off this level, because that's exactly, it did exactly what we hoped it would. Okay, so if you check the video, we isolated this swing high area, okay, that we were identified, I think, 2 weeks ago. And we're like, okay, the market should bounce off this area here. And it actually did. And somewhere around here, someone asked, okay, are we still short? I'm like, okay, let's wait for the market to drop to 107.08 for an opportunity to potentially buy, because you can see nice resistance structure, right? You had a big figure aside from these other things that we were using at the session, but we came out with the answer and said, okay, at 107.08, we're looking to buy the USD JPY. And if you did, okay, you're not doing too badly, right? It's nothing to write home about, right? You're not going to start quitting your job or anything, but you do have the confidence. It sort of like instills in you the confidence that, okay, what we're doing, yeah, perfect. So you bought it. Yeah, I think it's a really good position. Still think you should hold that one. Yeah, a lot of mistakes that they make is that they try to break even way too quickly. And so you just want to give your position breathing room. Right? Don't get too nervous around it. If it works out, it's going to be a lot of pips for you. If it doesn't, just try to minimize your risk on it. But I mean, if you got a good entry on this one, there shouldn't be any reason for you to worry about it. Okay. All right, guys. Seems like we have less than 1 minute left. We have less than 1 minute left. So if you guys have any questions, you can just shoot them through on our WhatsApp group to me directly. We are shifting from the WhatsApp group to the Telegram channel, right? So please just download Telegram. It's got space for much more people, right? Because we are at capacity now. The WhatsApp group is full. And also I'll be able to upload content there, more content, and pin it to the top. So for all the new guys who are coming in, they'll be able just to read that from there. And I'll be able to send out videos that are much larger than I would on WhatsApp, okay? Okay, we'll do analysis on the USD JPY next week, Monday, right? Okay.